Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
Welcome to the Turnaround Podcast. Last week, we spoke to Richard Heiss, who for a time was the Chief Restructuring Officer of Steinhoff, the South African retailer which was the subject of a multi-year worldwide restructuring. This week, we welcome Matthew Prest of Moelis to the show. There is a link between the two in that Matthew, as we will hear later, worked on the Steinhoff restructuring, which Richard discussed in the previous week. Matthew has over 25 years of financial restructuring experience, advising companies, financial sponsors, secured lenders, and bondholders. Additionally, he has helped clients and continues to help clients raise debt and equity finance. He's a well-known figure in the market and has worked on many of the most high-profile, sensitive, and complex situations in Europe and Asia. Prior to joining Moelis, Matthew was managing director in the corporate finance restructuring team at Close Brothers, where I first met him. And before that, Matthew was a director of restructuring at M&G and a senior manager in the restructuring team at KPMG. Matthew, welcome to the Turnaround Podcast.
Thank you, Stephen. Great to be on. Thanks for having me.
Well, I'm going to ask a very basic question. What actually is a financial advisor in a restructuring context? I think we all think of financial advisors as people who help us with our investments and ISAs and things like that. So I'm sure you can enlighten us.
Yeah. So I think there's probably a short answer to that, and there's a long answer to it. I'd say the short answer is, as actually my boss Ken Moelis says, is that we're like the fire brigade. You know, when somebody's house is on fire, we run in as everybody else is running away. And I think that's very much, the basis on which, we operate. I think the longer answer is that there is both tangible and intangible elements to what we do. I mean, clearly what we're looking to do is to really kind of like try and get the best outcome for our clients in the circumstances available. But really, it's where, when you've got a company that's kind of about to default on its debts or has defaulted on its debts, we've got to kind of find solutions that, as I say, kind of bring the best solutions for our clients. But the tangible elements of those are obviously things like, reviewing the financial information, understanding the prospects of the business and the value based on those prospects. It's also an element of process management in terms of herding all of the kind of like the cats, herding all the different stakeholders that are in the process, and really just trying to kind of like put a process around what can be a very, certainly at the start, a disorganized and chaotic situation. Get a process and a framework around it with a view to kind of driving people towards getting a deal and the best outcome that's available. The intangibles, I would say, are anything from agony aunts in terms of like spending time listening with your clients, spitballing, whether it's on a Saturday night if they're anxious about something. And sometimes you just listen. You sit on the phone, you listen, you provide comments, or ask questions, and they're not really looking for you to kind of like give them anything other than your ear and just to kind of like listen. They just want to chew things over in their own heads. So I think there is that element. Sometimes they want an outlet to kind of to express frustrations and just like offload it. And again, you've got to be, pretty thick-skinned and to be able to kind of like take that. But you realise that it's people are often stressed out in what are difficult situations, and they need an outlet. So there's that, and it's also just kind of like building trust around the process, because ultimately, if there is, again, like paranoia generally reigns when a restructuring starts. Everybody's worried that one side or another is going to kind of get the better of them in some way, or get a better deal. And it's not obviously what you want to try and do is kind of like build trust, so that people's can then be in a better mindset and at least trust the process sufficiently. I mean, you're never going to achieve 100%, of course, but at least sufficiently trust the process to be able to create the environment for getting a deal done. So, that's the longer answer to the question.
But just talking about some of the tangibles first. So, presumably, do you, when you go in, I mean, do you begin to start constructing a model for the company as it should look going forward once you've dealt with the debt issues? I mean, is modeling part of the offering that you put together?
Yeah, I mean, I think generally, I mean, not always, but generally, the companies that you're dealing with have not got the strongest financial departments or teams, right? Or the strongest financial forecasts. Maybe one of the reasons why they're in the situations they're in, right? So clearly what you want to be able to do is, I mean, the key thing first is to understand the liquidity situation of the company, because ultimately, how much time have we got? Have we got time to be able to negotiate a debt restructuring? Have we got a year, or have we got 3 weeks, 4 weeks? And obviously, we're not going to get anything done in 3 or 4 weeks, but you need to understand what the liquidity situation is, and then what you can do to try and bridge, and to be able to get, find, work with them. We'll get onto the operational restructuring advisors in a minute, but work with the company and the operational guys to understand, okay, how do we either find liquidity through working capital management and the like, or do we need to try and find some form of new money to be able to bring into the business? How can we find liquidity to be able to then create a bit more of a stable liquidity platform to then be able to look at the longer term prospects for the business, and to be able to evaluate those? And yes, then you're going to, so there's potentially in those first few weeks, you're trying to establish and work with the company to ensure that there is a robust cash flow forecast, a short-term cash flow forecast that exists. And often you'll go into the company and say, do you have a short-term cash flow forecast? And they go, yeah, no, we've got a short-term cash flow forecast. And they show, can we see it? And you look at it, and it really isn't kind of like fit for purpose, right? Because they've not been through one of these kind of processes before. And then you need to kind of like help them construct something that is. And so there's that kind of like initial liquidity forecasting, and then obviously, provided you can then kind of like have the liquidity to be able to then work on the longer term plan, you're then working with them on, okay, well, what does the next 3 to 5 years look like based on where we are today, and how, and obviously you've got to then stress test those assumptions. You can't just have some kind of blue sky scenario from where you are today. You've got to kind of like ground it in reality and figure out, okay, based on where we are today, what can be reasonably achieved? And therefore, what does that mean from a returns perspective and a value perspective? Is there a story which people can back? And that's what you then help model at the end of the day. So you are helping them model that in a way which then all of the different stakeholders around the table can look at, review, and have some degree of confidence in around those numbers.
So I guess I'm getting this. You construct a model, but how do you sort of decide going forward what are the constituent elements of the model? What part of the business will succeed, which part of the business needs to get chopped. How do you sort of determine going forward how to restructure the company? Because there's an element of the finances and what the debt's outstanding, and in some ways that's a negotiable question, isn't it? You can always sort of change the debt profile or get rid of it, do a debt equity swap. But there's the additional element of, well, how can you predict the actual revenue that's coming in? So how do you reconcile those sort of two elements that you need to get a forward plan going?
But fundamentally, you need a management team. In reality, it's going to be very difficult for a financial advisor on their own to model out the prospects for a business, right? You need a credible management team that has a plan, and it's their plan. They have to own it at the end of the day, because ultimately, the financial advisor isn't going to be there over the next 5 years developing it. You have to have somebody that, CEO, CFO, management team to say, look, this is the plan that we reasonably believe, given where we are today, we can deliver. So you have to have a management team, a stakeholder, all the different stakeholders around are going to want to have a management team that they can at least. Now that sounds great in theory, but of course, in practice, you may not have a management team that you have that faith.
I was going to ask you, those are the people who drive it into the wall, possibly.
It could be, and so that's part of the assessment, right? Which is, when you go into these situations and you start asking questions of the senior management team as to why we're in the position they're in. Are they grounded in reality, or are they blaming everybody else? Right, at the end of the day, is it everything else other than what's and those are the things you've got to try and kind of at least get a handle on first, and then obviously if they don't have that, or if you do have a concern, then that's what the operational kind of restructuring firms are there for, is to provide that assistance and help to bridge between where you are and finding a new because at the end of the day, those people know what stakeholders are looking for. They know kind of the things that the information that's required, and obviously they come without any baggage to the table in terms of the situation itself. So that obviously, management assessment, senior management assessment, is a key early assessment that you need to undertake. But let's just assume for a minute that you've got somebody that you can work with, and that you've got some degree of confidence in that they can pull something together. Then the way that you look at it is, you have to then you try and you pull together a business plan, and there's an iterative process, right? It's not just like a plan of business. They will pull together a plan, and then you may iterate it a few times, and you see, well, why is that business? Why do you want to invest in that business? Or that business looks like it's absorbing a lot of cash. Why do we want to kind of keep that business going forward? And a lot then comes down to return on investment, right? Because I do think, again, a lot of people kind of look at EBITDA and what EBITDA is it going to create? But the big question is, how much capital and reinvestment is required to generate that EBITDA at the end of the day? How much capex and how much working capital and all that? Because that has a cost to it, which you have to then factor in. And therefore, does it actually offer a sensible return? Like what if you're asking somebody to put new money in to back a plan, well then what's the return on that investment? Or at least what, and you can't say obviously X marks the spot. It's going to be, here's a range. This is at least the reasonable range, or the bell curve as to what the outputs might be. And then people then you have to kind of discuss with those people as to the finance providers as to whether that offers a reasonable underwrite case or not. And if they need to, and if it doesn't, then you're going to need to adjust the plan to kind of like maybe reduce the amount of capital that the business needs to over the next, to invest in it, and then maybe have a more capital light model. But those are the kind of things that you're having to work with. So it's an iterative process. But yeah, it does come down fundamentally as to, do you have faith in the management team? And of course, if you don't, then it's just that much harder for everybody, right? To get that conviction to be able to put a lot of money to it.
And I guess if you've gone into a situation and you think, oh, this management team does need bolstering, I mean, it's a sensitive issue, isn't it? Because they may well be the people who've taken you on, so it's quite hard to sort of turn around at that point. So how do you manage that situation?
Yeah, it's a great question, and I think ultimately it needs to be a conversation around. Firstly, you have to kind of make it clear to the management team what is expected of them, and therefore, and that there are people that are available that can help, because this is all about you've got to make it about them at the end of the day, because you can't, the more you kind of feel like they're being imposed upon, as you say, some CEO, ego gets involved. So you've got to kind of say, look, to the board as well, you've got to say, look, your reputation and credibility it's all about how we deliver under this process. And if we can go through this process and retain or rebuild slowly the trust of your stakeholders, so that they are willing to kind of back a plan and everything else, then you're gonna look good, right? You're gonna come out at the other side of this looking good, right?
Yeah.
And so you've got to change it into, what does it mean for them, right? What's in it for them? And everybody's different, but people will care about that, and people candidly will also care about the management incentive plan and all this kind of stuff as well, and the potential opportunity that exists there if you kind of get the deal done. But it's going to be all about, the only way you're going to get a share of the management incentive plan going forward is if people actually think you're credible, and the reputation's there and everything else. Otherwise, you won't be around to share in that new MIP. And so it's about kind of encouraging them to see that it's actually in their benefit. It will benefit them to bring somebody on board, to help them through a process that they shouldn't have faced before, right? These are kind of normally, and hopefully for most people, one-off processes which they've not got much experience of. And so it's all about saying to them, look, you rightfully don't have the experience of what this is like, and so bringing these people on will enhance people think, actually, these guys get it, and these guys are credible, and enhance your reputation. So it doesn't always work, but that's what you're trying to do. And then if it fails and there's too much resistance, then frankly, the lenders at the end of the day are going to kind of say, they'll make it clear, right? So one way or the other, it's kind of happening one way or the other. It's, do you want to go the straightforward way and look like you're in control of what's happening?
Yeah.
Or do you want to have it forced on you and have it put into the standstill agreement or whatever it is, that you're getting done, that you have to have this person? Surely it's better.
Yeah, and I'd also say that this is sort of one of the things that I've been involved in over many years, where you also have to have a sort of legal perspective on what your duties are at that point as a board. Yeah. Your duties have to be to act in the best interest of the company. And there's a sort of duty shift that occurs, obviously, in financial distress, where actually you should be starting to look at what's in the interests of the creditors, rather than the company, so rather than the shareholders. So you do get a situation where sometimes boards might be very shareholder aligned, and then you've got this situation where they have to suddenly change their worldview on who they should be following orders from
Yeah.
effectively.
Yeah.
So we've talked. I mean, what I get from this is that you've got both the very sort of hard yards, tangible, putting sort of pieces of paper together, doing modeling, all that, getting a sort of a view of the future. But there's also really interesting psychological issues. We talked about how you deal with the directors. Perhaps you can sort of explain a little bit about stakeholder perspective, like creditor perspective, other perspectives that you see, and how you deal with those stakeholders. Maybe other employees, maybe it's bondholders, maybe it's lenders. Maybe there's sort of government entities involved. How do you sort of manage all of those?
Yeah. So I think the key thing first is to try, as I said, build a degree of transparency and trust around the process, right? Because everybody is, not unsurprisingly, when things go wrong, everybody wants information immediately. Everybody has got a boss somewhere on top of them saying, what the hell is going on? You give me answers ASAP. And so obviously that puts them under pressure to they're then on you saying, I need answers ASAP, what's going on, etc. And so first you've just got to understand just human like nature, right? Which is that people are like stressed. They are, as I said before, that degree of paranoia that, if I'm not kind of like in the room somewhere, there's a risk that somebody else is going to get treated better than I am, and then I'm going to look like an idiot, in front of like my committee and my boss, etc. And so, the more that exists, the harder it is to get a deal, because then people may just react and do something because they see shadows, and so they do something. They accelerate, they unfold, whatever it might be. They do something because they feel like they have to do it, right? And of course, what you're trying to do is really kind of try and dissipate that as much as possible. You're never going to get rid of it, and obviously you're never going to get rid of it 100%. But what you're trying to do is dissipate it so that you build trust around the process. And so I do think it's important to try and like really do put a process around it and give people the confidence that everybody's being kind of like treated like as fairly as possible. And I say that because of course you do have to kind of prioritize certain things at certain times if it's a big situation. And on top of that, it will become apparent as you obviously do your homework, do the analysis, that certain people may be in different legal and financial and therefore recovery positions to others, right? And so that's, for me, a basis of anything is really trying to figure out, aside from like what's the liquidity position and have we got time, all that kind of stuff, is then okay, if it's a really big situation, like how much debt have we got here? Like who are the debt? Trying to map the debt situation, and then start trying to figure out what the counterfactor is. If this does kind of like go the wrong way, what's everybody's relative positions? And of course, in a complicated situation, which we'll get onto, like Steinhoff, that you can't do that in a week. You can't figure that out in a week because the financial information, it's all very complex, right? So, so you're trying to create and assure people that you are, in the meantime, like working, and you're not looking to try and disadvantage somebody over another. And you just got to be transparent as possible, and you've got to be as much as possible including people. And of course, you're always going to get people chewing your ear off saying you're not I'm not feeling the love, and you're not giving me the time. Oh, I think you're doing this, and you've just got to try and spend time to try and build that confidence and trust. And so I think that is singularly the most kind of important thing, is to try and do that to start with. Because obviously, from a stakeholder perspective, if you're a creditor group or a particular creditor, you're like you're like, you've got like a somewhat of a one-track mind, right? Your view is you see the restructuring through the lens of your credit position, right? And how can I best, best kind of get the best outcome for my credit? And so if you're a creditor advisor, you're kind of like looking at it a lot more through that lens. If you're a company advisor, you're back to what I said about really trying to kind of, stakeholder management, create that trust, put a process around things. And, you have to see, to your point about directors' duties and everything else, you've got to see the bigger picture, right? And just try and keep the show on the road to maintain as much value, keep the pie as big as possible so that there's actually something there to then negotiate over at the end of the day. So those are the things that you're kind of dealing with.
So I think I've just picked up on one thing you said there, which is it's almost like what is everyone's position, and I guess what you're really zeroing in on there is if this all goes horribly wrong and there's no restructuring and the plan doesn't get fulfilled and you don't have time and it just goes into a kind of horrible liquidation, some people are going to be fine and some people are going to be absolutely toasted in that scenario. So presumably part of what you're trying to do is look at that situation and say, for the most part, almost everyone loses, lose a lot, and try and encourage people to sort of go down the kind of sunlit uplands route of a restructuring rather than the sort of the Armageddon of the opposite. I think often that you do see people being encouraged towards the deal by, let's call it sort of plan Bs. So I'd love to understand, whether you've used this sort of alternative plan B when you've done restructurings, and what people are referring to when they're talking about plan B.
Yeah, I think that the answer is yes. I mean, you have to use it, regularly, particularly if you've got, holdout groups, holdout creditors. You do need to use the the stick, so to speak, of the plan B. And like the plan B can take manifest itself in a number of ways. I mean, on Steinhoff, for instance, we had like multiple people all the time who, for their own good reasons, were saying, well, look, I'm going to pull my lines, I'm going to pull my, I'm going to accelerate my loan. And it's like, look, if you do that, we've got a bunch of retail companies that are underneath this, which they're going to evaporate, right? The value will evaporate, right? And I couldn't, because we didn't have an entity priority model at that point because it was so complex. But you've just got to kind of like give the picture that the alternative, if they're going to kind of like carry out on their threats, is the alternative is that the thing is just evaporate. Retail company, good luck. You're gone in that scenario, and your value upside is your value recovery is going to be minimal. But I think in alternative scenarios, it comes to where you've got, like, for example, a junior creditor group that may be arguing that they want an outsized proportion of value attributed to them in a restructuring, because they see the world differently to everybody, to what the rest of the people do. Well, then I think, if you've got like everybody else on board and they're like kind of like holding out, then you've got to make it clear to them. They could be creditors or they could be the shareholders, right? If you need a shareholder vote, for instance, you need to kind of like go to them and say, look, we'll give you, in order to get your consent to this deal, we'll give you like X. Well, we'll give you an amount which we think is worth around what you might get, or maybe even a little bit, something a bit more than what you'd get if if this went into insolvency and we did it another way. But if you don't agree to that, then we can put this through a pre-pack administration or UK restructuring fund, whatever it might be. Safeguarding France. to, and in that scenario, we'll give you you are only entitled to what the relevant alternative is, and if that's liquidation, we have you as a zero. So actually, that's kind of like where you're going to be. You're an out the money creditor, and therefore, we won't give you anything. So, if you force us to go through with having this to go through court to kind of implement this, then you're going to get nothing, or you'll get very little. If you agree, we'll give you more than that, just to kind of like, because we're also avoiding the costs and everything else of going through that. So that's the kind of concept of the plan B, is that you are kind of like showing, if you like, the holdout parties, whoever they may be, over the edge of the cliff. That's what it looks like. Which one do we? What are we doing?
And it's interesting, I guess. The relevant alternative, what you're alluding to there is the fact that we've got a couple of tools now in the UK. One that's very long standing, the restructuring scheme, and the other one's the restructuring plan, which is coming quite recently. And the plan is the thing that now that you're able to effectively cram down shareholders, dissenting creditors, etc., in a way that we couldn't do a few years ago. So I guess that dynamic is really, well, do you think that has now really changed the restructuring dynamics in this country?
Yeah, I mean, I think it is an important change. I do think it does make a difference. And look, the fact that you have to still go through a court process means that you have to be able to properly demonstrate it, in front of the court as to why it's valid. But absolutely, I mean, I think, look, ultimately these things, you generally had to go through a pre-pack administration or something like that beforehand. Whereas I think using the restructuring plan, I do think kind of like does change things. So from that perspective, I think it's going to be interesting. The interesting thing, I think, that we've yet to see properly play out, or properly be tested, I think would be the main way to say it, is that where a new money tranche has been put in to kind of bridge to a restructuring, and that new money tranche is then used as the tool to cram everybody else down in the restructuring, as the voting class, so to speak. I think that's going to be interesting to see how that kind of dynamic plays out going forward.
Yeah. When we discussed, we had a little pre-discussion, and I said, well, I'm going to ask you what some key sort of career highlights, and you did mention Steinhoff, and we've talked about it a little bit on this. So do you want to just talk about the situation you found yourself in Steinhoff, and maybe if there's another sort of key case that you've been involved in, we'd love to hear about that as well.
Sure. Fascinating situation. So just by very brief way of background, in December 2017, Steinhoff, which was probably about a 25 to 30 billion euro market cap business, global retail business, headquartered in South Africa, but had businesses Europe, US, Australia, etc. It announced it had uncovered accounting irregularities, CEO gone, the big charismatic CEO Marcus Euster gone, and obviously, as they announced that, having been like, if you like, a debt capital markets darling for years, and raised a lot of debt from all kinds of parties, suddenly became pariah, and everything shut down. The world shrank for them in an hour, right? In a matter of like hours, the world shrank for them. And so we got a call from Linklaters, and we headed down. We were asked whether we could, they were the company's lawyers, and we got asked whether we could be in South Africa, in Stellenbosch on the Monday morning. This was late the week before. So in fact, just a couple of us at that point flew down, and at that point, what you're dealing with, forget all the kind of like financials and everything else. Going back to what we're saying, it's about people, right? There's like, you walk into a building you've never been in before, you've never been to before. You don't know what you're going to enter. You walk in with your suits on, in through the front door, and there's a mix. There's a mix of people that are looking at you saying, okay, these guys are here to save us, and they're just looking at you going, what do we do?
Yeah.
And you've got another group of people that are looking at you going, we don't need these guys. This is all a storm in a teacup, all a big misunderstanding. We'll be fine by the end of the week, right? That. So you've got that kind of you've got this kind of thing, and you're trying to like figure out all. You've got like all kinds of people kind of like coming in, telling you what the answer should be, and all these grand plans that they've got to save, and it's just a melee at that point. And so what you've got to do is try and start defining for them at least okay, guys, it's like somebody once said, I mean, how do you eat a whale? You can't eat a whole whale. You've got to eat it in small pieces, right? And so the point is, guys, let's just get to the end of the week then first, shall we? Let's just aim from where we are today, Monday morning. Let's get from now until the end of the week, Friday. And then let's see where we are at the end of Friday. Because you can't look much beyond that because of the, everything. And so then it became one of just like trying to understand, as I said, the cash flow and where's the cash. And, we had calls from all of the different businesses. And the thing as well, the interesting thing about it is, and I did say this to the interim CEO afterwards, I said, look, it's these things are always fascinating. I said, because it's almost like a medieval court. I said, you've got you've got a business. You imagine Steinhoff Group is king, right? They're the king or queen of this kingdom, and then you've got all the barons who are the managing directors in the different businesses. And I said, well, everything is good. The king is wealthy, and he's kind of like giving patronage to his barons. The barons are happy, right? The barons are happy, and that's great. The minute the king is weak, right, then the king is perceived to be weak or doesn't have, in this case, have the money. Then all bets of the barons, then kind of like turn, right? They sense opportunity, right? Just like it happened in Medi, and that's what you see. So again, you've got to start figuring. So you're sitting in Stellenbosch in this like lovely environment, quite frankly, lovely offices, and Stellenbosch. I don't know if you've been. It's a lovely
Yeah, it's beautiful.
part of the world.
Yeah.
And then you realize, oh my God, like you're looking at the group, trying to figure out the group chart, and you think actually the action, like the issues are like they're in Europe and like in Australia and the US. I mean, like we're just in this little kind of, on this little ivory tower in Stellenbosch, and like all of this stuff's happening out there. And they're like obviously shouting like, we need cash, we want this, we want that. And so you've just got to then try and manage it. So it was a truly kind of like that, those first few weeks. And myself and Louis Dupré, who's like the CEO now, we had like this saying we always used to say, because I'd said, let's make it through to the first Friday. And so for pretty much the 2 to 3 years that I was working with him after that, Louis always used to kind of like say to me, Matt, it's Friday. We've survived another. It's Friday. And so that was just that's the way it evolved. We just took 1 week at a time and tried to process. And through time we got through it. It was, obviously there was some pretty kind of like nerve-wracking times, but that was I always say that was my Champions League final of my career.
Yeah, and actually the way you described that sort of was making me chuckle, because as I was listening to it, I was thinking, I'm involved in something where exactly what you've just described has happened to a particular group, and I'm helping the board of the company where it's the shareholder that's exploded, and I'm basically saying, detach yourself from that shareholder. This is causing you major problems. Look to your own interests. So it exactly that scenario plays out, and I think there is a sort of tragic King Lear type quality to the explosion of a group in those kind of situations, isn't there?
Yeah.
But so that was your Premier League title, as it were. But I'm sure there are other highlights and anything else that you've been involved
I think there's been lots of interesting, defining points, I'd say, was involved in I won't say the company, but it was a early days when I was in my early days at Close Brothers. And it was a leveraged buyout that went wrong. I was working for the creditors. The creditors took control. The CEO, who was the founder, it was in Italy. The CEO, who was the founder, there was a trust issue there. So ultimately they let him go. But then they kind of found all kinds of things. Letting the founder go, he had years worth of roots into the business. And let's just say, without going into too much detail, it was a classic case study in what you've never learned at business school, right? And it opens your eyes to, we can all be sitting in various lawyers' offices in the city and everywhere else, kind of talking, there's all proper and everything else. But in the real world, there's a whole bunch of stuff going on that you need to be alive to as well, right? So that was an interesting one. And then the Icelandics, I guess, is another big milestone for me, working with the Glitnir winding up board, which I started in 2011, and we finally got it done in 2015, working with a whole bunch of the creditors on that, and just really experiencing the dynamics with all the politics that the local politics of Iceland involved in it as well was kind of like a very interesting thing.
And what's going on now in the restructuring scene? We've gone through, obviously, COVID, which created expectations of a massive wave, and then the governments around Europe and in America just sort of stopped it dead, really, with all sorts of loans and legal stoppages to any kind of restructuring. So we're now a few years past that. We're seeing not great economic figures in Europe. What are you experiencing at the moment as a restructuring shop?
Yeah, I think we're experiencing, I'd say, a steady flow of situations. If it's difficult to nail down a specific trend within that flow. There's quite a wide range of different situations. Obviously, Thames Water's in the news at the moment, on the one hand, which is an idiosyncratic. Well, you can argue whether it's idiosyncratic or not, but pretty idiosyncratic. But I would say, if I had to kind of pick something, I'd say the thing that we're beginning to see as well is that there's companies that maybe aren't needing to do a restructuring now, because there's been a lot of there's maturities in 26, 27, 28. But what you are seeing is tightening free cash flow or interest coverage ratios, which and in fact, companies that have got negative interest coverage ratios as well, which although their maturities are fairly far out, as their interest rate swaps roll off as well, which they'll have probably set when interest rates were, they managed to kind of lock in interest rates at a lower rate before they went up. They're now having those swaps are coming off at a point when the interest rates are still relatively high compared to where they were, and that's squeezing the kind of the cash flows of businesses further. So I do think there's in certain situations, I think we're looking at where we say, oh, well, there's no debt maturity until 27. So is there really a trigger? And then you start looking and you think, well, actually, there may not be a trigger, but there could be a liquidity need, which they're going to somehow have to fill. Now, either the equity tips them in, or they're going to have to use the flexibility under the debt documentation to bring in. And so that's what you've got to try and then go and start discussing, or try and discuss with them, is to, okay, how can we help you, given the loan documentation you've got, kind of find ways to kind of, if you need liquidity, what are the options you've got in order to be able to do that? And then, of course, if there's debt's trading at maybe a significant discount, that's not always the case. There's a lot of debt most things are kind of in the mid 80s or above, so there's less opportunity to capture discount. But if there is, then again, how might you be able to do that or create? But to be honest with you, you can kind of like put a set of options on the table, and some of them can be kind of like, reasonably sporty in terms of, and ultimately the sponsors and the directors might listen, politely and say, well, that's all interesting, but it's too racy for us. We want to do some things. And so that US whole creditor on creditor and J. Crew stuff and the like, it's yet, there's some people would obviously point to single examples, but it's yet to really kind of manifest itself in Europe. It might do, but it's yet to, I would say. And I think a lot of that is to do with cap. Just a lot of the time is the game worth the pain, because the cap structures are maybe smaller.
It's probably worth just saying to the audience, when you say J. Crew, it's essentially it's sort of dropping assets into a group company that is an unrestricted subsidiary. In other words, a subsidiary that's not subject to any of the covenants, etc., which is not available for the creditors.
Yeah.
I'm going to ask you the final question. I don't know if you've got an answer to this. We haven't rehearsed this, but if you were the king of the restructuring market or in Europe, Matthew, is there anything that you would do to improve things as we speak?
So I'm going to give a cop-out answer, Stephen, which is I believe that that generally additional kind of like changes by top-down, by government and by kings or whoever generally lead to bad outcomes, right? I'm a big believer that the market works things out, through experimentation, through time, and thousands and thousands of interactions, and generally that then comes up and becomes law in due course. So I don't believe in kind of whether it's dictatorial power or whether it's benevolent or not. So I'm going to cop out of that. And in any event, if I gave an answer, no doubt some smart lawyer will then kind of like come to me and say, well, if you did that, then it would have the following knock-on effects, which would be all negative. So
Matthew, I actually think it's a brilliant answer, in the sense that what you've encapsulated there is the difference between, common law and code. Essentially, there's the system that we've been working on for years is basically precedent by precedent. There's no such thing as a pre-pack in the Insolvency Act in the UK. It doesn't exist. But we've done it by precedent. So it's a good answer, and I think we've run out of time. But I think it was a real tour de force of how to be a financial advisor in Europe. So thank you very much for your time, Matthew. I think the audience will really appreciate today.
Thank you for having me on. Appreciate it.
Thank you.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, freilibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.